And joining us now to share his commentary on the day's market performance is Kearabilwe Nonyana from Scope Prime Africa. Kia, thanks so much for your time this afternoon. And I guess we should start with the Fed holding rates for the third time this year. Policymakers highlighting stagflation risks. This as we navigate the tariff environment. No surprises, right? We're seeing the Fed on the side of caution as usual until we see more stability, more certainty.
I think certainty is the name of the game, and I think one of the things that people have never been able to come out of has been stagflation, and that's truly an environment that world economics has really hasn't figured out how to get out of. And I think it was quite prudent from the Fed right now to keep rates on hold to see the effects of these tariff wars on employment as well as inflation. I mean, if we really look at the U.S. economy, it's sitting at almost full employment and a decreasing inflation. So I think with that being said, because they have this dual mandate on price as well as the labor force, I think for them, they really are at a comfortable level where they don't need to act on the economy right now. So what they're trying to see is, are there going to be second and third round effects of these tariffs on the economy, on inflation, as well as the labor force?
You know, Gia, we look at the hard data and we are seeing strength on that front. But I think what worries me the most is the soft data. When you look at consumer confidence, when you look at business confidence, those are quite downbeat. Shouldn't this be perhaps something that the Fed starts considering?
I think you are quite right, and I think it's, for me, it has been a lot to see with how business leaders in the U.S. in the preceding earnings season, the outlook statements have been rather bearish, and it truly speaks to investment in that economy, and that might start affecting the labor force in the fact that they might start looking at the fact that they will freeze hiring. And you saw in the last labor numbers, which came out in non-farm payrolls as well as people looking for unemployment benefits having risen. It speaks to the fact that corporates might just turn off the taps on employment just to see how these tariffs are going to affect the economy. And looking at outlook statements, for me, I always say earnings seasons are about history. Outlook statements are about the future. And really, confidence in that economy has died down. But Ndawleng, we did a study recently looking at the dispersion in sales towards the China and the US. And to be perfectly honest, US companies only sell about 7% of their GDP to the Chinese economy, while conversely, the Chinese economy can survive without US-backed products. And truly, for me, that's where you see global economic power being shifting in the past few months.
Yeah, it really is a wait and see game because no one can be too sure. Let's move over to some company results. AB InBev kicking the year off strong. Upbeat profit for the first quarter, partly on the back of stronger pricing. Markets really liking the numbers. I think the last time I checked, the share price was above 2%. What stuck out for you? I think it's really interesting to see how they've managed to grow margins in this environment, clearly showing that everyone likes a little drinky drink.
I think it's quite defensive in nature because people will always look at drinking even in hard times. But I think what's really quite interesting in this result is seeing volume decreasing in the US and China, which are the two biggest markets. Even though they had margin integrity, seeing prices increase across the board, what we are seeing is genuinely decrease in sales but increase in prices, which tells you about really the price point of their brands. And then two, it also tells you about the efficiency in management, and AB InBev has always been efficient.
And what do you think is perhaps the reason of the decline in sales in the US? I mean, we know in China we have a consumption issue there. What could be the reason in the US?
I think you may have touched on it in the beginning in terms of consumer confidence.
Okay.
I think people, when they start to see that there might be headwinds for their economy, you start seeing that consumption expenditure, discretionary expenditure starts decreasing. And for me, those were the telltale signs that maybe these tariff wars have started affecting consumer confidence.
Let's look at Naspers and Prosus. Now, those companies both out with updates. Prosus in particular exceeding its e-commerce profit target. Take me through just your analysis on that update.
I think it is overall a great result, but I think for me, it's the fact that this corporation has started investing outside of China and focus on other
Yeah.
emerging markets, and you're starting to see some of those businesses show great results. I mean, we haven't got much color in terms of the performance of each and every business, but you're looking at the classified business such as OLX, which is really seeing growth, CAGR above 23%. And for me, it's those businesses which are going to be a telltale sign on how the future of this business is going to be. Because really, they have been a one-trick pony in the fact that they've invested quite well in Tencent 20, 30 years ago, and it's really paid out dividend. It is how then do you come in right now and find other investments like that in these environments?
And we've seen that recent investment in Europe, and you know there was some uncertainty and some worries considering how the European economy is performing at the moment. But it'll be interesting to see how that plays out. Carl Group reporting a downbeat numbers, but they did declare a dividend. Both revenue and profits coming in lower. The group, however, upbeat about its prospects in the second half. What did you make of those numbers?
I think it speaks to the economy more than anything else, and I think just because of the fact that things seem a bit better with a rising consumer confidence in the South African market does not necessarily translate into a better economy. What I mean by that is that sometimes the effects of the economy are going to be seen in the number. But I think it really speaks very well of management to maintain a dividend because it speaks about strong cash flows and an ability to still have quite a good balance sheet, even though the economy is not performing that well.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on some counters that have been attracting interest from your industry peers.
Very, very seldom would call a commodity stock. But I think the sum of the parts is worth more than the current share price. I think when De Beers and Amplats and the Aussie coal assets are gone, what you'll be left with is a transaction that I think a couple of global miners would consider to be very attractive, particularly BHP Billiton because of their portfolio. So, yeah, I think Anglo-American, and frankly, I quite like the platinum story driven through Amplats because I think the PGMs, you've seen more and more capacity coming offline. So, you've got to have a mildly positive view on Amplats because you're going to get some of those. But I think Anglo's right now is looking like there's money to be made simply as this corporate action unfolds.
Simon, I'm saying I like the apparel retailers. Why? Because of the tariffs. There's now a lot of manufacturing capacity for apparel that's available cheaply in the East. The rand is stronger. Oil prices are lower. Interest rates will probably be cut twice in South Africa based on the forward curves in the current year. A VAT increase that was going to happen is now no longer going to happen. So I think there are many tailwinds for the apparel retailers. They look cheap. They trade between 8 and 12 times. Foschini's at the upper end of that. But they have, I think, the additional benefit that there's quite a lot of debt on the balance sheet. And as interest rates come down, that variable rate debt will reset. So I think you can buy almost any of the discretionary retailers, but we pick Foschini from here. And I think the management team are competent and they've executed well. And I think Anthony Thunstrom has a vision for what he wants to do, which most investors buy into.
So Shane going with TFG and Graham going with Anglo-American. I've always found it really interesting how a buyout bid has really forced Anglo-American to get its things in motion and just really restructure the business. Just your analysis on those counters.
Yeah, I think Anglo American has been one of those businesses which have just been scared by a bigger player coming in to buy it. And what they have is just getting a clarity of strategy in terms of how do we move this business, which is a behemoth, into the fourth industrial revolution. And they're looking at metals which are going to be looking at cleaner energy. And I think they've streamlined the business with the proposed spin-off for some of those businesses and selling off businesses which are really not making them much money, like De Beers, and just straining on group resources. I think the investment into metals such as copper has really streamlined this business, and really you can now start comparing them with their competitors like Rio Tinto and BHP. And I think with the TFG group, I do agree with Shane that I think the discretionary stocks on the JSE are looking very, very well priced in comparison to resources counters in the gold space.
Yeah.
But I really I really do believe it's one of those things that my team really do like TFG Group, and particularly because it caters to LSM 4 to 10 and has athleisure components to them that I think it speaks more to younger demographics as well. TFG for me is not my preferred play. Even though my team does like it, I
Okay.
do like going down a bit lower on the LSMs, such as the Mr. Price Group, which have really more hefty valuations, but I think they cater to more a demographic which is into fast fashion. And as Shane speaking, because of tariffs, because of people moving their production lines to the east, I think Mr. Price has a unique advantage that they have people on the ground. But I really do like both these stock picks, Anglo American and TFG Group. I just in the apparels, I like Mr. Price more.
All right, so Mr. Price, not your stock pick. You are seeing value there, but what are you picking today? What's your stock pick?
It's AVIC, Xi'an Aircraft Industry Group. I think it's quite an obscure pick, but it speaks more to the tensions between Pakistan and India right now.
Okay.
And with the global defense systems always having been skewed towards Europe and as well as the US, I think with Pakistan, with the rising tensions, you started to see Pakistan using aircraft from China, and seeing the advancement in that technology might shift global defense spend towards the Orient more than it has been spent in Europe as well as the US. So that's my stock pick for now. It's a hefty valuation, but it's been up almost 30% in the past 2 days.
All right, Gaya, we have to leave it there. Thanks so much for your time and taking us through trade at midday. That was Kearabilwe Nonyana from Scope Prime Africa.